me hit record here. All right, cool. We're recording. So, all right, I will just hand it off to you, let you introduce yourself first. And then really the first question I had for you at least was like, what's your background, how you got into the mortgage business, namely the 203K side, which we were kind of just talking about. But.
So I'm Scott Saypol. I work for Loan Depot. I started in the business. Let's go back. Actually, my parents owned a mortgage company when I was growing up.
Oh, cool.
So I was working there probably from the time I was 13 years old. Went to college. It was about 2008. My parents said, the only thing you can not go to college for is business and finance. You're going to stay away from the mortgage business. Don't want you getting into it. It was a tough time for lending at that time.
Yeah.
And, I actually went for marine science. So I got a degree in marine science. I worked for the government for a couple of years. Decided it wasn't really my thing. I was always interested in real estate investing, the lending side. So came back to Jersey from Rhode Island, and I hopped right in. I mean, for me, the 203K was the first product that I really saw, that I really learned. And it was even the product that I used when I bought my own first house.
Right. Cool. So I'll lead that into the second question, right? So what was your experience with doing a 203K?
So I had a great experience with the 203K. I personally, I think everybody that has an interest in real estate investing should buy a multifamily as their first house. I didn't do that. My wife kind of put her foot down on that. So I said, you know what, if we're not going to buy a two-family, we need to buy something that makes sense. You know, there needs to be an end game with this. And we bought a foreclosure. It was a lakefront property. We picked it up for $270,000. This house had been vacant for 5 years. There was a tarp over the roof. There was no plumbing. The floors were covered in mold. I mean, the house was a disaster.
Literally my duplex.
What's that?
You're like almost explaining my duplex. I bought it for $271. There was a tarp on the roof. It wasn't on the market that long. Actually, people were living in it in that condition, which was bizarre. But yeah, no, it's so funny. It's like you're basically explaining.
Yeah, this house definitely not moving condition. It had been vacant for about 5 years. We bought it for $270,000. We borrowed about another $90,000 to put into it. When we were done, it appraised for $450, roughly $450. And we took out a home equity line of credit against the equity. Well, first we refinanced. We lowered our payments. Mm-hmm. And then we had $80,000 in equity that we could use to flip and do whatever else we wanted on the side. So we only brought about we had a seller's concession for closing costs. So the seller actually paid our closing costs. Uh-huh. We brought $14,000 to the closing table. So I brought $14,000 to the closing table, and within 6-7 months, I had a line of credit for $70,000.
It's crazy, man.
It was a no-brainer.
Yeah, it's so funny too, because like this is literally, the numbers are exactly what I did. Like everything, like to a T. Like I put 90, I picked it up for 270, put like 90 or 80 into it, all in for 350. It appraised for 460. The HELOC, on my first flip, I didn't use the HELOC, which was stupid, and I learned from it. And I'm doing that now. I'm trying to get a HELOC, but of course I messed up my credit when I was doing my own flip because all my credit was jacked up. So by this month, it should be back up, and I'm going to take a HELOC out. But yeah, basically what you explained is like the ultimate strategy of starting.
Well, the ultimate strategy is starting with a two-family,
okay,
or a three-family, or a four-family. And I'll tell you why is when you buy your two-family, three-family, four-family first, your down payment requirement is 3.5%. If I bought my single-family first, I can't occupy a two-family. No lender, no underwriter is going to believe that I'm moving out of my single-family house on a lake into a two- or three-family that I'm really going to end up buying as an investment property.
Right.
Now, if I am going to buy that two-family as an investment property or three-family, my down payment requirements just went from 3.5% to 15 to 25%.
Yep. Yep.
So your barrier to entry just went from, on a $400,000 house, you went from $14,000 to, it could be on a $400,000 three family, that's $100,000.
Right. Now
that's your down payment. That's your skin in the game.
So now if let's just say on the case that someone does have a house right now, whatever reason, they don't have an FHA on it, but they do want to buy like a small multifamily up to a 4-unit. They want to do it with a 203K. And they intend on moving into that house. Is that something that lenders look at? They try to flag? Do they think,
they will flag it if they don't believe it. You really have to be able to justify why you're moving from a single family to a 2-family or a 3-family.
Wow. So they ask for like an affidavit or something?
Sorry, what's that?
Do they ask for like some sort of like affidavit, like saying that, or
they would definitely want a letter of explanation.
Wow.
It's very difficult to prove, but maybe you have a valid reason. I mean, maybe you have a small condo and it's a 1-bedroom, your family's expanding, and your new unit's going to be a 3-bedroom in a better school district, closer to family and friends. I mean, it really comes down to how well you're able to explain it and justify, and if it is a true unit that you do plan on occupying.
Right.
I wouldn't play the game, that you're going to occupy something you're not.
Mm-hmm. But yeah. Oh, exactly.
People do every day.
Yeah, of course. So, I mean, people ask me that all the time. Even in my case, I'm like, full disclosure, I had it ended up being like an 8-month rehab. It went 2 months over the allotted 6. And in that 8 months, I got engaged, and my whole life changed actually in that 8 months. And before the end of the loan, I was able to refinance out because I built enough equity into it. So I did refinance out, and I got into a conventional loan, and I ended up not really moving in, because by the time I was ready to move out and move in with my fiance at the time and everything like that, the thing changed. But I was no longer really under the regulation anymore. It's just something that I like to tell people.
It's not even so much a regulation. It really, with an FHA loan, you're supposed to intend to occupy the property within 60 days for a year.
Of course.
Now, obviously, circumstances change. You got engaged. You're not in the same place. Project takes 8 months. Your circumstances change. Yep. No lender is going to penalize you for that.
No. Especially what I tell everyone is, at the end of the day, pay the mortgage. If you're paying the mortgage, they really don't care what you're doing.
They don't care what you do. If you're making your mortgage payments, you're not on their radar.
Right. But I do want to drive home the point, which is what you were saying before, is that this is still and should only be a first-time home buyer loan. This
not
is
necessarily first-time home buyer.
No, I'm sorry. I call it first-time home buyer. Right. So it's basically it's a beginning of your buying properties hopefully down the line journey. Right. It's something that you can utilize, but it's not something that you use multiple times. People always ask me. I mean, the biggest.
Well, you definitely can. I wouldn't even say that, because let's say, I used a 203K to buy my first 2-family.
Right.
And, like you did, you refinanced into a conventional loan from there.
Right.
There's nothing that would stop you from now going and purchasing a single family home and using that 203K.
Yeah, I guess like you said before, it raises flags if you go in the opposite direction. I don't know if I'd want it to raise flags in that direction. You know what I mean? Because they would know that I do own a cash flowing.
That's fine. There's nothing that's absolutely fine.
Okay. That's good to know. See, this is why you're on the call, right?
Yeah.
So yeah, I mean, in my case, with the HELOC, I use hard money now, and I get good rates with that. I only need to put down 10%, and then they cover all the rehab, everything like that on top of it.
Now, are you doing multi-families with hard money or single families?
No, single families.
So with single families, there's actually a Fannie Mae home style, which is very similar to the 203K, but it can actually be used on single family investments only. And the interest rates are about half of probably what you're paying for hard money.
Awesome. Can
It's a
you talk a little bit
15%
more
down
about that?
payment
Because
requirement.
give like everyone that's watching a little more of a quick breakdown of the home style loan. So this is something that you told me about. I knew about, but you told me a little more about. So like, tell me how it compares to a 203K. Tell me how it's better than a 203K, and tell me how it's like worse.
So FHA is a government insured loan product. For that, you pay for that government insurance. You are paying 0.85% annually included in your monthly payment, and you're paying 1.75% upfront. FHA has slightly lower down payment requirements, 3.5% down,
Versus 5%, right?
versus 5% down on a single family owner occupied Fannie Mae home style,
Okay.
15% down on investor Fannie Mae home style.
Okay.
Because Fannie Mae now uses private mortgage insurance, if you have a better credit score, your mortgage insurance costs are much lower. You're also not going to pay that 1.75% upfront fee that FHA actually adds to your loan balance. So
You pay any points up front?
that 5% down and a better credit score, the home style is actually a much better product for you on a single family property.
So is it even better than, how is it better than hard money?
Well, the rates are much better. So even as an investor, I don't know what you pay for hard money. I'll tell you, in my market, it's about anywhere from 2 points and 10% to 4 points and 14%, which a point being 1% of the loan amount.
Yep.
On a home style, for an investor, single family, you're probably maybe 2 points if you put 15% down, maybe no points if you put 25% down. And interest rates are probably today in the 5 to 6% range.
Wow. Yeah. So it's definitely comparable. I guess it depends on your strategy, but I think another thing for people to know is like, this is another option, right? If there's a lot of people that do have like, a Fannie Mae, have an FHA loan already. Like they already own a single family. That's what they live in, but they're looking to do this type of strategy. So they can use a home style loan basically. Cool. All right, awesome. So I have a bunch of questions here, a lot of which people that follow the 203K way asked, and a couple that I have myself. So the next one, this is one a lot of people ask. Obviously, probably the first question you ask, which is what are the minimum qualifications for a 203K, and what are optimal qualifications? What do you look for? What makes it easier on your end for a 203K?
So really minimal qualifications. We're looking for a 620 credit score, 2 years stable employment. And then the lender is going to look to see what you qualify. They look for debt to income ratios. You'll hear DTI. Really, it is your total monthly debt divided by your total monthly income. Ideally, on an FHA loan, your total debt shouldn't exceed about 55% of your total monthly income. And your housing expense shouldn't exceed about 45%. Now, if you're buying a multifamily, in addition to your income that you get from your salary or your everyday job, we can use 75% of any unoccupied rental units. So you'll actually qualify for more on a multifamily than you would if you were to purchase a single family.
Right. So I remember that was something that they found out while they were doing my loan, and they didn't know about it until they were like realizing they couldn't approve me for the 350 loan amount. They're like, we can't do it. And then one person was like, no, what's the projected rental income on the other unit? And they told me it was like 2,200 bucks a month. And then I was able to qualify. Yeah, so that's another point for multifamily with the 203K, right?
Yep, definitely qualify for more.
So on that topic, I'm going to skip around the questions a little bit, but so on this qualification end, where do borrowers get hung up? Where do they miss out? Like what's the hardest thing that you have to work with them on?
That's tough. I'll say every borrower is different. Usually it's income. I say, a lot of real estate investors or people getting into it, we're looking for 2 years stable employment, and we're calculating your income based on that.
Okay.
So, if you've had a salary job, for 2 years, that's easy, no problem.
Right.
If you've been working, maybe driving a little bit for Uber, working in a couple different restaurants, that's where it gets a little more difficult.
Okay. So if they do have that, right? What's like the best case scenario? So I know for me, I had a couple different incomes also. Like I had like kind of like a side gig. I had my regular W-2 job, which was good, which was a good foundation. I know that I had to fill out like a lot of paperwork and a lot of like signed documents, me confirming, this, and the guy that owned the company that I did some side work for, he had to like write things like what do you look for people to prove, to prove all their income, and like what's the next step if they're just not a W-2 stable income over the last 2 years?
So if it's not like W-2 stable income, we're going to go to your tax returns. So
Okay.
the income has to be reported on your last 2 years tax returns, and we're going to take a 2-year average.
Okay. Excellent. So that's what I'm trying.
On the net income. So most self-employed people driving for Uber, even real estate agents, people that own smaller, like the gig type employee, they file a Schedule C on their tax return. And let's say they took in $60,000 in income over that year. A lot of people now, they're going to deduct their travel expenses, their meals and entertainment, certain expenses they had in earning that income. Well, when the lender looks at your tax returns, we're going to take those deductions into account as well. So even though you made $60,000, you only told the government that you reported $30,000 after those deductions. Well, we can only now use $30,000 in income.
Interesting. I didn't know that. See, because now on a DTI on a W-2, it takes your gross income, right?
We're using gross. Yep.
Interesting.
But that's gross only accounting for taxes. When you're filing Schedule C, you're basically saying I'm a small business.
Right.
And these were my expenses that I paid in earning that income.
Right. So they're doing it for the right reasons, right? They're trying to get under a tax bracket. But when you're trying to get a mortgage, it's important to know that, see, now this is something I didn't know. That's
it definitely affects you.
Yeah, that's really good to know. So as far as like when people go to get started, they're interested in 203K loans. They want to get the ball rolling. What should they go after first? Should they start looking for properties first? Should they be looking for a lender first, contractor, realtor?
Always talk to a lender first. Don't waste your time without knowing what you qualify for. Don't waste your time, a realtor's time. If you're going out looking for properties, but you can't get funding, it doesn't matter.
Right.
Talk to a lender first. They're going to be honest with you. They're going to tell you what you qualify for, what you don't, what's a pipe dream, what's reality. And then you can, narrow down your search from there, and you know what to look for.
So I wrote my little like kind of book called, it's something that that people can download at my website. But basically, that's what I did, right? So my book, has a step-by-step guide at the end on like what I would do. So knowing what I know now, how would I do it over, right? How would I do it this time? Like learning so much from doing it the first time. And in my case, I did get a lender first, and that was like one of the things I did do right. But the thing I did wrong was I got the first lender that I knew in my phone book and used that person. That's where I didn't make it. So I actually have like kind of an approach like that. I kind of have like a number one, number two, like mixed together. But basically, first I like want people to pick a market, like just an idea, just to get a general guideline of what it takes to put a down payment on, on a house in the.
And that's exactly what the lender is going to ask you, because they're going to need to know kind of what market are you looking to play in? What are the taxes in that market? A lot of people ask me, well, what am I qualified for? Well, most of my clients are thinking purchase price. I'm thinking monthly payment. That's it, because that's how we qualify you.
Sure.
So if I'm qualifying you based on your monthly payment, a $300,000 property with $6,000 in taxes and a $300,000 property with $10,000 in taxes have far different payments.
Yeah. Yeah.
You're talking about $350 a month.
Right. Yeah.
So $350 a month in terms of borrowing power, that's probably about $70,000.
Right.
So you might qualify for $70,000 more in purchase price on that property with $6,000 in taxes, as opposed to that property with $10,000 in taxes. So I can't really tell you a purchase price in terms of what you're qualified for. Sure. I can only tell you a loan amount or have a rough idea what the taxes are in your market.
Great. That's a cool thing to think about. Obviously in our neck of the woods, the Northeast, New York, New Jersey, Connecticut, taxes are high here. Taxes are definitely higher than other parts of the country. I work with a couple people that kind of asked me for a little more mentorship, and I was working with one lady and she's out west and there's no taxes. I mean, it's $800 a year, something sick. And they have more buying power that way. And actually their dollar goes a lot further out there. But that's something that's really important. Yeah, for me, it was luckily where I bought was low comparatively to the area. So it was about $9,000, $9,000 a year in taxes. They just jacked it up on me actually 2 months ago and jacked up my payment. My payment went up $200 a month, which is terrible. And I had to raise the rents on my tenants this month. But yeah, that's another point to think about. So yeah, I mean, I want to drive home the biggest thing to go after is making sure you not only find a lender first, but find a lender that's qualified in this. So assuming they don't live in, the Northeast and someone that you couldn't recommend, which I'm sure I want you to kind of give your info at the end. If anyone lives in, New York, New Jersey, Connecticut area that wants to take advantage of this loan, how would you recommend someone that's interested in this finding a lender that isn't gonna suck?
Talk to somebody that's done it before. Okay. I mean, find somebody in that market that, does 203Ks. I mean, if you can't find the lender first, start with realtors. I mean, realtors are always putting themselves out there on social media, in advertisements. Look for ones that are specializing in people that are buying these properties to renovate, because they're going to know how their clients are financing them. And most of them are going to be 203K loans.
Awesome. What do you think is, we kind of touched on this before, but I thought it was a pretty good question again. What's the number one requirement owners constantly miss or make mistakes on? I know as far as getting their information to you, right? Is there something that is the hardest to get from people, or?
With the 203K, so the hardest part is really actually getting info from the contractors.
Okay.
And being a contractor. We can't really move forward in the loan process until you lock down not only a contractor, but an estimate from that contractor.
Yep.
So that's kind of the difference between the 203K and hard money. Where hard money, you kind of got to have a rough idea of the repairs that are going into the property. With a 203K, I mean, we need to know exactly what you're doing to that property, because as opposed to a standard loan where the lender's lending you money based on the appraised value of that property, we're lending you money based on the after improved value of that property. So when we get our appraisal done, it's actually based on all of the improvements that you're doing. So that appraiser needs to know, well, what kind of tile are you using? Are you going hardwood or carpet? All of these things are going to be important in determining that after improved value. So really the most difficult part, I mean, contractors are good at swinging hammers. A lot of them are not very good at paperwork.
Yep.
So really want to make sure you have somebody that does have, a reputable contractor that can start the job with their own funds and can manage to get you the estimate when you need, and you can't continue to make changes throughout. I mean, you're not locked into, if you wanted blue paint or this tile, but, if we allow $6 per square foot for tile, you're going to be somewhere in that range when it comes time to actually pick that tile.
Right. I mean, so the one part where I had an upper hand in this whole thing, which was not even an upper hand really, was I did have a background in construction, and my dad's a general contractor for a long time, but because of conflict of interest, he couldn't really get involved. And we just kind of went and used a guy that he uses all the time, like a sub that he uses that was able to kind of oversee the whole thing. That being said, they had never done a 203K before. And it was a ton of paperwork. We worked with a 203K consultant, which, she was great and she guided us like through exactly how to do it, but there was a ton of revisions. I mean, I know that banks are super specific on how they want the scope of work to look, what needs to be written on there, the paperwork that needs to be done. Can lenders make recommendations on contractors before they go into the loan?
We can make recommendations. We're never going to force you to use anybody. I do a lot of 203K, so I do have, a lot of guys in my Rolodex that do have experience doing them. Mm-hmm. And really, that's one of the most important things. I mean, a lot of contractors, the biggest hurdle for a contractor in accepting a 203K job, other than the paperwork, is really the fact that they have to start the job on their own money. They have to lay out the funds for the materials to get the project started because they're not getting paid until the work's complete.
Right.
So that's really the biggest thing. And, you don't want to just hire anybody. You want to make sure that it's somebody that's obviously licensed, insured. And for a contractor, one of the benefits is they're never chasing a homeowner for money. They don't have to worry, well, does this guy have the money to pay me? On a 203K, the bank's holding the money. Once the work's done, the consultant goes out. He's going to check off all the work that's been done, the money that was allotted for each project, and he's going to release the funds to the contractor. So the money's there. The contractor has no worries.
What I was really surprised about is how fast that money comes to the contractor.
I would say, roughly 7 days.
In our case, it was like super fast. A lot
of times, depending on how quickly your consultant gets the paperwork in, they usually email it right to the bank and the bank overnights a check. 3 to 7 days usually at the most.
So, I talk about this a lot, right? So like, it's funny because if you look up 203K loans online, on blogs and stuff, working with a 203K consultant, it's on the con side when it says like pros and cons. And the way I saw it was actually kind of a godsend because you have this neutral third party because they're just hired. They're a third party. They don't work directly for the bank, so to speak, right? They're kind of
work for the buyer.
Right. So, what I tell people again, like for another reason that it's like your first, if you have any interest in flipping properties ever in your life, you should always use this as your first because you're basically getting like a flip on training wheels, right?
Yeah.
You're getting a dose of that. You're getting a dose of like finding a deal. You're getting a little bit into like buying a house. Then you're getting a little bit, you're like building a scope of work. But then you don't have to worry about fighting and feuding with a contractor. Number one, the contractor has to be licensed and insured for you to even start working with them, right? Because the bank vets them out. They make sure that they're a legitimate business. So you're not getting screwed there. And then you're just kind of sitting in the background, just watching the whole thing unfold while, there's no arguing with you on what was done and what wasn't done, right? Like my dad grew up in the contracting business, how often that he would get owners that would hold back money because, they didn't, one of the screws wasn't screwed in one of the cabinets, you know what I mean? And they'd hold back like $8,000. So he always had to fight with that. In the 203K, that's not the case at all. It's
not your responsibility.
Yeah. So, I think a 203K, now listen, of course you don't want a 203K consultant on every single flip you ever do, but it's good to kind of take, because for a lot of people, the rehab is a scary part. And for me, it wasn't, but I understand it is for some people, but the 203K consultant really takes that fear out of it, I feel like.
Yeah, he's making sure, obviously that you're not getting ripped off by the contractor, right. But you also want to make sure there's enough money allotted to each project to finish the job. If you got bids from 10 contractors and, one came in at 50,000 and the rest came in at 70,000, and you hired the guy that was charging you 50, he's going to do $50,000 worth of work and he's going to disappear, whether that job's done or not.
Yep.
So the HUD consultant's job is to make sure there's enough money there that any contractor can come in and finish that job that you started at a fair price, a fair and reasonable price.
Right. Right. I mean, yeah, the contractor side, I think, is really important. It's overlooked. It's also an area where I feel like people shouldn't be fearful, because you have so many people working with you. It is once the contractor gets on the ball with it, and in most cases, like you said, I highly suggest that you get either the HUD, the bank or the HUD consultant to make a recommendation on people they've worked with before. So you don't bring in a contractor that's like completely like, whoa, what the heck's all this? It really goes a long way. Again, one of the follies that I made, another huge thing. Real quick, I want to talk about, the rehab process. So a big question people ask all the time is, what happens when it's rehabbing and I can't move in? So can you tell me a little more about that little check mark that my freaking lender didn't check that would have saved me probably like $20,000? What's the thing that you're allowed to do where you can build
You can
in?
actually finance up to 6 months mortgage payments into your loan so that you don't have to pay rent and a mortgage at the same time while the construction's going on. If you can't live there, you can finance those mortgage payments. And I mean, roughly speaking, let's say your mortgage payment is $2,500 and you finance 4 months payments, that's going to cost you roughly an extra $55 a month.
Right. It's like nothing. Right. And ideally, if and in my case, I was having a duplex, so I wasn't really paying the mortgage. I was only paying a fraction of it. My tenant was after the case, but that was a tip that just I found out about it down the road after they closed on the loan. I was like, I saw it. I was like, what? I could have done this. It killed me. I mean, luckily.
That's why you got to work with someone that does these every day.
I know. It was something that luckily I was able to swing. I was working 2 jobs and I was living with my parents during this whole rehab process. So I was living rent free. But that's a big, big, big nugget that I think people need to know before they go into it, because an unqualified lender isn't going to know that, and that'll cost you a lot of money. What can borrowers do to make your life easier, if anything?
Get us the documents when we need them. We need all the documents up front. If we ask for your tax returns, your bank statements, your pay stubs, your contractor's estimates, the sooner the better.
Right.
These loans, I'll tell you, the fastest ones I've done are 3 weeks. The average is probably about 35, 40 days. Most lenders are taking about 60. But it's all on you. It's all on you and the contractor, because we're waiting on you to get us the documents. I mean, we can work as fast as we can work, but if we're waiting on you to get us that pay stub or that missing page of your bank statement, we're held up completely. We're at a standstill.
Right. I have a little story in my book that goes over like how they needed the estimate and they were like threatening to back out, and but they needed it that day, and I was in Tennessee, in some rural part in Tennessee, in like the Dollywood area, like Dolly Parton's like a theme park, and we're driving back in a minivan, and I'm using my father-in-law's iPad, and I tethered the internet off of my phone that kept on going out because I was like typing up the scope of work because the contractor didn't do it right. And I had to like fix it to send it in to the mortgage broker that day because like they needed to get the clear to close or something that night or something. And it was just like, I wanted to blow my head off. And it was like, but I understood, I understood the need to get this stuff done quickly. So I think it's something that people probably sleep on. I always try to tell people that are getting into it, like, talk to the lender first, and like have them give you a list of what they need from you to like get this thing done. So you could start going like right away. Like maybe you're not looking to do something immediately, but at least you like know and have a hit list on what to get, so that when you are ready to go, it's like, boom, here you go. Here's, get the contractor in, do the bid, get the 203 guy in and leave. So 2 more questions for you. One is down payment assistance options available. Are there any available for 203Ks? I know it varies by state. I just wanted to know what people's options are if they still can't swing a 3.5% payment.
So if you can't swing the down payment, with any FHA loan, you can get a gift from a family member. So if somebody, mom, dad, brother, sister, aunt, uncle, can gift you that money, we can use it. We just have to source it from them. Down payment assistance is limited. However, a lot of towns and cities have their own grant programs available, and we can use any grants that you apply through those cities.
Cool. Have you ever used one yourself, or like on anyone's loans before?
I used one in Patterson. That was probably about 3 years ago. I don't know if the grant still exists or if there's funds left.
Right.
But
how does it typically work? Like, I'm actually not familiar with it at all, but I was just curious, like, how does it work? What they give you, just like a certain amount of money based on?
Yep. In a lot of areas that need revitalization, if they know, you apply, and sometimes the problem is the process for the grant takes a long time. So you're applying to the town or the city, and they might approve you for, $5,000 in funds, and that can be used towards the down payment.
Right. How long does the borrower need to have the down payment? So when you look at a borrower's like bank statements, what's like the guidelines you look for on like, are you checking to see that they have enough to cover the down payment amount? Are you looking, where does that come in?
We just want to see that you have enough cash to close on the transaction. So your down payment plus any closing costs you're responsible for. So you can get a seller's concession to cover your closing costs, up to 6%, or the lesser of 6%, or the actual cost of the closing. You can't have the seller cover closing costs and any part of your down payment. The down payment has to be brought by you. We're going to look back 2 months into your bank statements to see if there's any large deposits. Any large deposits have to be sourced. Mm-hmm. Now, that doesn't mean we can't use them. We just need to see that they came from an acceptable source. If you maybe you sold another property, maybe you got a gift, maybe it was just a big paycheck, the underwriter is just going to want to know where that came from.
I actually have to do that.
Draw on a credit card to put down for the down payment.
Listen, there's ways to leverage it. I mean, what I try to drive home with people is, listen, 3.5%. It's the best you're going to get anywhere ever. 3.5% is like absolutely ridiculously low. I understand some areas, like even my area, like $10,000, it's a lot of money. But I think what people also need to understand is, if you're looking to do this long term, if you're looking to be financially responsible, if you can come up with a savings plan with you and your spouse, something like that, to accumulate the down payment in your market, in your respective market, just getting more money down the road doesn't make things easier, right? It's not like, once I flip the first house and I have $100,000, like it's going to be so much better with money. No.
But what happens when you do buy that house and you're done with the 203K and, now the water heater goes?
Right.
Water heater, furnace, you could be looking at $7,000. You want to make sure that you're not putting yourself in a strapped position by coming up with that 3.5% also. So while 3.5% is the first hurdle, I never want to see somebody pretty much bankrupt themselves by putting down the down payment. You should have, and actually if you're buying a 3 or 4 family, you're required to have 3 months reserves.
Okay. Good to
So
know.
if your mortgage payment is $3,000 a month, after you close, they're going to be looking to see $9,000 in your bank account.
Interesting. Awesome. Good to know.
Just in case that unit doesn't get rented right away.
Yeah, absolutely. The one crazy thing that happened with someone that was like I was kind of mentoring, she's in Connecticut, and she offered on a property, and she said that the realtor told her that banks don't cover closing costs. Like foreclosures, like sellers don't cover closing costs. They don't do it.
Not true.
It's so not true. And it just pissed me off. I made a post about it on my Instagram recently. Like, beware of lazy realtors.
I mean, is really, it's a way of, the lender can only lend you 96.5% of the purchase price.
Right.
If you were buying that property for $300,000, we can loan you 96.5% of $300,000. If you buy that property for $310,000 with a $10,000 seller's concession, we're now loaning you 96.5% of $310,000. The seller is still netting $300,000 for that property.
Right.
All you're really doing is financing your closing costs by inflating the purchase price.
Yeah. Yeah.
It's not coming out of the seller's pocket.
No, it's not. So that's what drives me nuts, man. Like again, like the realtor just doesn't want to they don't want to, they want the path of least resistance, right? They want to get to the deal. They want to get the deal done. But so you agree, right? I'm not going crazy. I wasn't the only one. You did it on yours, right?
Yep, absolutely. And I had the money. It made sense to leverage it so that I had more money in my bank account, so that at the end of the day, after I did my 203K repairs, well, now I could buy furniture and maybe do some additional repairs, or
sitting on the floor.
Sometimes you find unexpected surprises. I did.
Yeah, we all do.
Also, with the 203K, if you allot $50,000 for repairs, they're going to force you to borrow 10 to 15% extra in case you open up the walls and you find knob and tube wiring, or you find something else. And that's your contingency reserve fund.
Right.
Now, if you don't use that contingency reserve fund after the repairs are complete, it just goes back, it pays down your loan balance, like you never even borrowed it.
Right.
But you're going to want that, because I'll tell you, I don't know the number of 203Ks that I've done, but I don't think I've done one where that contingency reserve fund hasn't been tapped into.
Oh, of course. Yeah. And again, right, going back to what I said before, the rehab on training wheels thing, right? Like, how many people on their first flip don't put any contingency in, or just think like, no, this is going to be perfect. Like, well, I'm not going to have any issues. And it always happens. It's there, right? Like, I tell people, like, listen, shit's going to go wrong. It's going to go wrong. It goes wrong on every flip I've ever done, every flip my dad's ever done, every construction project I've ever taken part of. Shit hits the fan. That's just the nature of the beast. And again, you have a bank, you have a giant entity that is completely invested in their investment, and they want to make sure that the thing goes down right. So any F-ups that you do on your end, whether it be like not knowing what you needed to get done on the house, having some issue with the contract or whatever, the bank's looking out for your best interest, because it's really their best interest. It's technically not your house. It is your house, but it's really the bank's house. So they're supporting you throughout the way. And again, if you have
I'll argue with you there. It's not the bank's house. It's the bank's collateral.
Right. Exactly. Yeah. So, I mean, it's something that they could go after, they could take back from you. They don't want a pile of shit. So, yeah, man, I think this has been pretty awesome. I'm going to go ahead and pause recording, but I guess, closing stuff, like any other tips or tricks that you think people should do, as far as any main points you want to drive home, and then how can people contact you if they are interested in getting a 203K loan?
Sure. Main points are really just work with your lender. Be honest. Don't let we will find out, the underwriter will find out. The last thing I want to do is, find out from the underwriter that they found something that wasn't brought up to me. If you can think of anything that might preclude you or, get in the way of you getting that loan, talk to me about it first, because we're here to work with you. We want you to get the loan. We want to help you.
Right.
That's really it. Work with us. Get us the documents when you need. Talk to us about the numbers. Don't take out, from the time you start the process, don't change anything about your financial picture. Don't change jobs. Don't rack up any new credit card debt. Don't go out and, get a new car. Always talk to us first. Those are the things that can stop the process very quickly.
Awesome. Yeah, I mean, I think one thing people think, I had this personally, right? Banks, like mortgage, I don't know what it is, man. People just seem really intimidated by like mortgage bankers and brokers, and they think that like you're like this, like you're human, like you're all humans, like, and at the end of the day, like closing loans for you feeds your family, right? Like what
Sure.
people don't understand is like, they're like, well, I don't know if I qualify. Okay, so talk to them and ask them. They want your business. They'll tell you exactly what you need to do. Like,
It all starts with a conversation. That's it.
and I tell, I tell other people, I tell people this as well. I parrot it all the time. Like, the obstacle is the way, right? It's a quote that I love. It's like my favorite quote ever, but it really is the truth. And it is in real estate, and it is in this freaking loan, right? I have people that ask me about like scopes of work and all this stuff and blah, blah, blah. And like, they haven't even like gotten pre-qualified for the loan yet. Don't worry about that part. Like, people tell me like, what do you do if you don't have 3.5% down? I tell them, I'm like, get 3.5% and then stuff. Like, it drives me nuts. Like, I was wondering the same thing. And then when I realized after 2 years that literally you can't do anything without a decent amount of money in your bank account, I just listen, I didn't build up millions. I built up 10 grand. That's like not, it's when over 3 years, it's not a lot of money. It probably could have been saved a lot faster if I was just more frugal, which I wasn't, but I also didn't know about it. But, again, I think people really just need to know, like, don't worry about the future. Don't worry about the deals. Don't worry about whatever. Talk to your lender first. Get what they need from you. Does your credit suck? Okay, we'll start the credit building process. I'm sure you have tons of connections on how to get people to build their credit quickly, right? You're
Yeah,
like,
I mean, if you're close, we can work with you ourselves. If you
right.
need a little work, I got 100 guys that I could refer you to.
Exactly. I mean, I'm doing it personally right now, right? I kind of messed up my credit. The guy that I'm trying to get a loan from is like, listen, I got a guy. He'll fix it up. He'll do what you have to do. And I'm in the process of it now. But that's the obstacle that I have right now to getting a new home equity line of credit. And that's what I'm attacking. So people should do the same. Like, if there's something that doesn't make sense or something that doesn't look good on your profile, talk to your lender and deal with it. All right, cool, man. So how can everyone contact you? Obviously, I'll leave the email if you have, but what's the best way?
Yeah, drop me an email or give me a call on my cell phone, 973-981-0385. I'll give you a link right to my webpage. I mean, like you said, some people are intimidated about making that phone call. You can fill out an application right on my website. I'll get the application, I'll review it, and then we can have a conversation, or I can shoot you an email and we can kind of discuss what you qualify for.
Awesome.
Don't get afraid.
You heard it, guys. Like, listen, I mean, I wish I had Scott on my loan. You have someone that not only did a 203K themselves on their own house. I'm sure there's not many lenders that have done that. And if there are, they're just like not, maybe they're privy to it, but they don't do it. But he specializes in 203Ks and getting, and like home style loans, I guess, as well. Like these repair, built-in renovation loans are huge. Cool, man. I'm gonna go here and stop recording, but thanks so much for your time, man. It's been awesome.
No, thanks for having me. This was great.
Awesome.